Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and recently a subscriber of mine here on YouTube asked me what are my biggest investments for passive income. I thought this was an interesting question because most people evaluate the size of their investments based on their value and not the income they generate. But this person is right to ask this question because ultimately the income matters a lot more than the value of our investments. In today's video, I'm going to highlight my 3 biggest investments for passive income. Together, they generate currently about $2,000 of monthly passive income. Before I get started, let me know in the comment section below what investments are generating you the most passive income. I'll be curious to read your responses. So the first company I'm going to discuss here is called Patria Investments. This takes the top of the list. It's currently generating me $1,000 of monthly passive income at the current dividend rate. Why am I investing so much in it? Well, for those of you who are not familiar with Patria, it's essentially the Blackstone of Latin America. They used to closely collaborate together in the past. At one point, Blackstone even owned an equity stake in Patria and tried to acquire the rest of the company. But the management of Patria, which owns about 60% of the equity, then refused the offer and decided to stay independent because they thought that they could create a lot more value by remaining independent. Today, Patria is the leading alternative asset manager in Latin America, managing about 50 billion worth of alternative investments like private equity, infrastructure, real estate, private credit, and so on. And I'm very bullish on Patria because I think that its potential as a future dividend growth company is greatly underestimated. At the first glance, it may not jump out as a particularly attractive dividend stock, offering just a 4.6% dividend yield and not having hiked its dividend in many years. But the context matters here. What's important to consider is that the company has intentionally kept its dividend payout ratio at a very low level in recent years because it wanted to organically pay off some debt that it accumulated following a few M&A deals. As a result, it has set its dividend payout ratio at just about 47%, down from 85% at the time of its IPO. But now this deleveraging is mostly completed, with its debt to fee-related income dropping well below 1 times, even as its cash flow keeps on growing at a rapid pace, and therefore I expect a near-term adjustment to its dividend policy. I think that this is especially likely because the lack of dividend growth has very clearly hurt their market sentiment and depressed their valuations in recent years. Its share price has performed really poorly relative to some of its close peers that are very similar, like Blue Owl Capital and Blackstone, which distribute a larger share of their cash flow to investors and attempt to steadily grow their dividend at the same time. I'll put a table on the screen comparing the valuation of Patria to that of some of its close peers, and you'll see that the difference is very significant. And this is especially intriguing when you consider that Patria is growing just as fast as its peers, it actually has lower leverage, and its business, which focuses on Latin America, enjoys a stronger moat and higher barriers to entry. The company has also guided to grow its fee-related income per share by 15% annually for years to come. Yet, the dividend payout ratio is very low already, the deleveraging is mostly complete, cash flow keeps on growing, and I think that the management has certainly become aware of the fact that the lack of dividend growth has hurt the market sentiment, which is not in their best interest either, given that they are the biggest shareholder of the company, owning over 60% of the equity. Therefore, I think that they are likely to instate a new dividend policy in the near term, and this could be as soon as their next investor day, which is in December, I believe, this year, or sometime next year. But I think that they are likely to adjust it, start growing their dividend steadily, just like companies like Blue Owl are doing, because it's clearly helping their market sentiment, leading to a higher valuation multiple, which could also then help Patria achieve even a higher growth rate by giving it access to cheaper equity to close new M&A deals. If they return to their previous policy of distributing 85% of their fee-related income, the dividend yield could reach a high single-digit rate. But I don't expect them to do that. I think they're likely to want to retain a larger share of their cash flow to organically finance new acquisitions. But even if they bump it up by some 20%, the yield will become very attractive and it could keep growing at a rapid pace from there on out. So right now, the market is not seeing the potential in Patria as a dividend growth stock, but I think that as this becomes clearer, the market is likely to reprice it at a much higher valuation, a lower yield, and I'm simply positioning myself ahead of the crowd to participate in this upside. Currently, it's already generating me $1,000 of monthly passive income, but already in a few years from now, I expect it to be a lot more than that. Hey, before I share the second company that generates me the most passive income, can you please do me a huge favor and click the like button and subscribe to the channel if you enjoy this type of content? It will help me a lot to keep on growing. Thanks so much in advance. Then my second largest investment in terms of the passive income I'm earning from it is Alexandria Real Estate, symbol ARE. It's currently earning me about $600 of monthly passive income. It's a great example of how REITs can turn into rental property-like investments that generate significant income. Again, it's paying me $600 per month, and that's only the dividend with a payout ratio of about 60%. This means that the cash flow yield that I'm earning is actually closer to $1,000, but the REIT is retaining $400 of that to keep reinvesting in growth, which will ultimately over the long run lead to a higher share price, and I'm receiving 60% of it in the form of cold hard cash that's hitting my account every quarter. Alexandria is the leading life science REIT and has historically during most times traded at very low dividend yields of just 2 or 3%, and that's because it has a very strong balance sheet, it has consistently enjoyed very rapid growth, and it has a very good track record. But in recent years, its share price has crashed by over 60%, even as it grew its cash flow by about 20%, as well as its dividend, and as a result, it's today offering at a historically low valuation and a historically high dividend yield of about 7%. The reason why it's so cheap is because the life science property sector is today severely oversupplied, and the market fears that this will lead to Alexandria's cash flow declining, which could even put its dividend eventually at risk. I agree that the oversupply is significant and that this will hurt the company in the near term. However, I think that the extent of the damage will be much more limited than what the market appears to think, and that's because of several reasons. Firstly, the company has 8-year-long leases on average. These leases include 3% annual rent escalations, and so it only has a small portion of its leases expiring each year into this oversupplied market. Most of its rental income is secured by these long-term leases and will keep on rising even despite the oversupply. Moreover, even those leases that are expiring, I expect most to be renewed because it's very costly and impractical to move from one lab to another, and this is especially true in the case of Alexandria, given that it owns really the crème de la crème, the best properties in this sector, and so moving to another building would mean downgrading in terms of quality. It could also be very disruptive, as perhaps the scientists working at your current building have chosen homes close by, now they need to move elsewhere, so it's very impractical to move to another building, and because of that the renewal rates in this property sector, especially for high quality buildings, is very high. Now the construction starts for new labs has dropped to a historic low because developers have already gotten hurt. Meanwhile, the population keeps aging at a rapid pace, and over 90% of the 10,000 plus known diseases still don't have a proper treatment. So I'm confident that despite the cyclicality in the demand, eventually it will keep on growing, it will eventually catch up to the supply, which will gradually come down in the coming years, given that construction activity has already dropped off very significantly, and so ultimately this oversupply will prove to be just temporary, and the impact on Alexandria will be more modest than what the market appears to think. I don't think that its cash flow is about to crash. I think that it's likely going to suffer a few years of flat cash flow, but again, this is not the end of the world for a REIT like Alexandria, especially given that it has a very strong balance sheet with a BBB+ credit rating, low leverage, long debt maturities, a low payout ratio of just about 60%. So I'm really not concerned about the safety of the dividend. I think that it's perfectly sustainable at the current level. Reminder, as I mentioned earlier, Alexandria's management has one of the best track records in the whole REIT sector, so our money is in good hands, and so ultimately I'm not too worried. I think that eventually, as the demand catches up to the supply, we're going to see an acceleration in the same property NOI growth. This could happen, I think, as early as 2027, and with that then we'll see a re-rating of the stock likely to much higher levels. Potentially this could lead to 50% upside, and even then it will still be very far away from its previous peak valuations. While you wait, you're earning a 7% dividend yield that's safely covered and likely to keep growing at a slow rate in the coming 2 years, but then potentially at a much faster rate after 2027. Therefore, this is one of my top picks for investors looking to generate passive income in today's market. As I said earlier, Alexandria typically is priced at closer to a 3% dividend yield. Now you get it at more than double of that, which is truly exceptional. My third largest REIT in terms of the passive income it generates is Big Yellow Group. This is the leading British self-storage REIT. It's currently earning me about $500 of monthly passive income. Big Yellow has many similarities with Alexandria in that it's a blue chip REIT, has a very strong balance sheet, it has historically enjoyed rapid growth, and it has an amazing track record. It's earned about 16% average annual total returns to its shareholders ever since it went public. As a result of this, typically the market has rewarded it with a high valuation, a very, very low dividend yield. It has typically traded at closer to a 3, perhaps a 4% dividend yield. But today the self-storage market in the UK is oversupplied. It's leading to a slowdown in its growth, even though it's still growing slightly, and the market has then punished it with a much lower valuation, even as the REIT kept on growing its dividend, and as a result the yield has now reached 5%. That may not seem particularly high, but you need to consider here that the loan to value of the REIT is only 14%, so it has practically any debt. It's mostly equity based, and this REIT has historically grown at a really rapid pace. They've managed to grow their FFO per share by about 12% annually on average since going public. So relative to the very low leverage and fast growth, the 5% dividend yield is very attractive and truly exceptional for this specific REIT. And just like in the case of Alexandria, I think that the oversupply will prove to be temporary here, and in fact conditions are already now starting to improve. What happened in the self-storage sector is that the pandemic initially led to a boom in demand for a few reasons. Firstly, people were moving a lot from one city to another as they lost their job, find new opportunities. At the same time, unfortunately, a lot of older generations passed away, left a lot of stuff behind. And then finally, a lot of people started working remotely from home, and so they needed to make space for a home office. So they often converted the extra room in the apartment, which was used for storage, into a home office, and then they needed to rent a self-storage unit for the extra stuff. So it created a real boom in demand, and initially these REITs like Big Yellow were able to grow their cash flows at really rapid pace, enjoyed very high occupancy rates, strong rent growth. But this was then met with new developer activity, of course. A lot of developers saw an opportunity to build new properties. They did so. Unfortunately, a lot of this supply started hitting the market right as the world went back to normal, with a lot of people returning back to the office, so not needing the storage unit and the home office anymore. Older generations became much more resilient to the virus thanks to the vaccines, and so on. And so interest rates also surged, and so people were moving less. They were not buying as many homes. So a lot of reasons why the demand cooled off even as the supply hit the market, and then as a result the market became oversupplied. But now new construction has already dropped to historic lows, and eventually the demand will catch up. This is nothing unusual. Real estate has always been cyclical. It goes through cycles of oversupply to undersupply, and now we're going through this cycle of oversupply. It will last for a little while, but eventually as demand catches up to the supply, the conditions will improve, and I think that then we'll see again a re-rating of the stock to a higher level. And given how discounted the stock has become, this could lead to significant upside. I think somewhere in the range of 30 to 50%. While you're waiting, you're earning a 5% dividend yield, and I think that despite now facing a few years of slower growth, it has the potential to return to its historic track record of 10% plus annual growth, and as it does, my passive income from this REIT will rapidly grow to much higher levels. Keeping score of your portfolio value is nice, but ultimately what matters is the income that generates you, and that's why at High Yield Landlord we focus first on income and on growth secondly. If you want to access our full portfolio, you can join us for a 2-week free trial. We will also give you access to our best research, our exclusive CEO interviews with different REITs, our course to REIT investing, our transactions in real time, and much more. It will be the first link in the description of this video. Also, once more, let me know in the comment section below what companies are your biggest investments for passive income. I'm curious to read your answers. Thank you very much for your interest. See you at my next one. Bye-bye.